The ECB is out of options, and it's bad. Now, when I talk about the ECB, I'm talking about the European Central Bank. Their back is against the wall like all the other central banks around the world. Now, the Federal Reserve in the United States still has some options, but it's forcing the hand of the other banks around the world, the other central banks around the world. Of course, the European Central Bank from Europe, the ECB, is the second biggest European central bank, or the second biggest bank. And they're in a bad situation right now. Their hand is being forced. So let's take a look exactly what's happening and why this matters to you. So what we can see, this article that just came out on Reuters, that the euro, which is the currency in Europe by the ECB, the euro is at parity. Its fate is now with energy markets. So its fate is out of its hands. Its fate is tied to the energy markets. We can see here that the euro's tumble below $1 for the first time in 2 decades puts it on course for one of the worst years in its history, especially if the energy price shock triggered by the Ukraine conflict tips the bloc into a prolonged economic crisis. So the euro's tumble below $1. So it's the parity between the dollar and the euro. We can see, here's a chart right here, and you can see here, now, this line that we have right here is really kind of more recent history. So really we want to look at everything on this side when the euro was actually created. But you can see all the way back here to 1980, the exchange rate between the dollar, the US dollar, and the euro dollar. Or I should say the euro, and you can see how much it's gone back and forth. But you can see since 2000, it's been above a $1 parity, and here we are all the way back down to a dollar parity. Now, why is that happening? And more importantly, why does that matter to you? Well, let's take a look at that. So we can see here that it says Wednesday's move opened the door for a move towards 96 cents. Analysts predict, with some expecting a fall to 90 cents if gas supplies are disrupted. Gas. We're not talking about gasoline. We're talking about natural gas. I've been talking about this a lot on this channel. I've been pounding the table on it for over a year. Europe has put themselves in a very bad problem. They decided not to get their natural gas out of the ground. They could. They have plenty of natural gas in the ground if they wanted to get out, but they don't because, the climate. So instead, they've decided to buy it all from Russia, and they're stuck dealing with Putin and, of course, with the Russia-Ukraine situation. They're stuck. So it says it could fall to 90 cents if gas supplies are disrupted. Well, they're probably going to be disrupted. They already are. As a matter of fact, it says that if this happens, the ECB is going to be in a bind. It is expected to raise interest rates next week for the first time since 2011 to combat inflation, running at a record high 8.6%. Now, I did a video on my main channel, I think just last week, talking about how the European Union is on the verge of breaking up. And I talked about this in detail. If you want to go check out my main channel, just search Mark Moss, and you can go watch that video. But we talked about how the European Central Bank has kept the interest rates below zero or negative. And now they're forced to start raising them because, of course, the Central Bank of the U.S., the Federal Reserve, is also raising rates. The problem is that this can cause a lot of problems. Let's take a look at that. It says the ECB cannot risk aggressive policy tightening for fear of sending economic growth into reverse. So they're kind of in this proverbial rock and a hard place. If they don't raise rates, inflation is going to continue raging on. And if they do raise rates, they could send all their economic growth backwards. Sounds pretty familiar, right? That's kind of exactly what the Federal Reserve is dealing with. But it says here, basically, we know it's all about Russia. So while the ECB thinks they have some control, they don't. Basically, we know it's all about Russia, as it says. It says, quote, if the gas pipeline that's closed for 10 days doesn't reopen, so Germany doesn't get natural gas out of the ground. Instead, they buy it all from Russia. It comes down through the Nord Stream pipeline from Russia. Now, with NATO, including the U.S. and Germany, waging war against Russia, supplying Ukraine with weapons, do you think Russia would want to continue selling energy to its enemy? I wouldn't think so. I'm surprised they've continued to sell it for this long. Seems kind of weird. And so they've had to close the pipeline supposedly for service. They say it's going to be closed for 10 days for maintenance, for service. I'd like to get your under-over analysis on whether you think they open that back up. Go ahead and leave me a comment down below. But it says it's closed for 10 days. If it doesn't reopen and we could get more gas rationing, meaning we don't have enough gas to get around, and we're going to choose who gets it and who doesn't. In that situation, we may not have seen the weakest levels of the euro. So the euro is hanging in the balance. If this pipeline doesn't open back up in 10 days, either because supply chains are broken down, they can't get the parts, repairs take longer than you expect, Russia doesn't want to turn them back on, or any number of other reasons, then it could completely crush the euro and their ability of what they can do. And it says here, spiraling energy costs are already exerting a toll. It's already exerting a toll. But the thing that we want to watch for here is the gas prices. They're the key. The euro era is already facing quote-unquote parabolic gas price spikes, with supplies down 53% in June. The industrial powerhouse Germany has witnessed a 60% supply decline. So in that video on my other channel, go watch it, talking about how the European Union could break apart, I talked about how Germany is the powerhouse and how it really drives Europe, or drags Europe along, where most of Europe, specifically the pigs, Portugal, Italy, Greece, Spain, they're not very productive. They're getting dragged along. And we talked about how we talked about how Germany leads that. But if Germany is down 60%, they've lost 60% of their supply for energy, how can they continue to be that powerhouse? How can they be the engine that drives Europe if they got no energy? And that's a big problem. And of course, supply and demand, if you cut off 60% of the supply, what do you expect is going to happen to the price? Oh yeah, it's going to go parabolic, as they said. Now, why does all this matter? Okay, it says why the euros fall below parity versus the dollar matters. Okay, so what's the big deal? The first thing to keep in mind is that the previous time the euro got to parity with the dollar was between 1999 and 2002. All right, and it sank as low as 82 cents. The thing is to keep in mind is that the euro banknotes and coins weren't introduced until 2002. So while the exchange rate dropped, we didn't have the euro currency at that time. So that's a pretty big deal. But the other thing is, like I said, everyone is being forced to raise rates because that's what the dollar's doing. So we can see here the U.S. rate hikes have boosted the dollar's appeal, and also as global recession fears have sent investors flocking to the safe haven dollar. So all these investors that have been parking money in euros are seeing it lose value to the dollar, and they want out. They want to cash out as fast as they can, and they want to go to the safe haven of the dollar. Even European citizens, I would imagine, would want to do this. If you could choose to save your money in pound sterlings or euros or dollars, what are you going to choose? You're probably going to choose dollars, and that's exactly what's happening, which is exactly what they can't afford to have happen. That will cause runs on the bank. That will cause investment dollars to flee, which will only cause their problem to get worse and worse and worse. Now, what does this mean for the ECB? Well, letting the currency fall would push up already record high inflation. That's a problem. It's already record high. They can't really deal with that. But fighting back against 20-year lows for the euro would require more rapid rate hikes, which could then add to the misery for an economy already facing a possible recession. The proverbial rock in a hard place. This is what happens when you pretend, when you make believe with monetary policy for 50 years. Eventually, someone has to pay the piper, and we're coming close to that. Now, could they keep this going for a while? They probably can, but we are getting close to, as Luke Graham would say, we're seeing the signpost everywhere, and this is one of those signposts. But let me know what you think. Leave me a comment down below. Of course, as always, give me a thumbs up on this video if you like it. While you're at it, please click on that subscribe button and the bell notifications so you know when I put new videos out. And that's what I got. All right, to your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.